Olex Network 18, Mission Poshan, Bhavishya Roshan.
Hello and welcome to Halftime Report. Well, it's a good trading session. We're halfway through the trading session. In fact, we're trading in the green after quite a bit. I'm Nigel D'Souza and with me is Surbhi Upadhyay. Well, Surbhi, over the last few days, we have had red on the screen. Today, it's looking quite good. You know, you got a sense yesterday when the Nifty defended the 100 DMA twice that, in fact, yes, the bulls are willing to put in a bit of a fight. So the 10,550, that's the mark that, in fact, we have been defending. Now, in fact, we're up close to around 65 points. We're up nearly around, what, a goodish bit from yesterday's lows as well. And the key levels you are watching out for, the 100 DMA, 10,550. The other levels that, in fact, the bulls believe that they will defend is the 200 DMA. That comes in at around 10,361 approximately. The 50 DMA, that could be the near-term stop loss as well. And the highest open interest at around 10,600 put. That's telling you that some part of the street believes at least the headline index will not breach that mark of around 10,500, 10,550, at least with the cues that we have as of today. The most active strikes today, 10,600 put, 10,500 put, as well as the 10,400 put. You're getting the sense that that raging bull is ready no matter where the hawk is, you know. That's the sense at least, just going by the screen. And good to see the mid-cap index as well, trading well in the green. After a while, we have more number of stocks that are advancing in comparison to the number of stocks that are declining.
Oh, absolutely. Raging bull. I mean, I don't know the last time I heard that term, considering the way the market has been falling. Absolutely. I mean, it's been really quite torrential on the way down. But in any case, just to add, I think the policy is what everybody is now watching out for. And maybe the market's priced in the possibility of hawkish language. So let's see. I think the next move that we'll get is around 2 to 30 onwards. Once that announcement is out, then we'll know whether this can continue or whether the sellers will come back, because that's been the problem last 2-3 days. Every bounce got sold into. So let's see if today is going to be any different. Well, this is Halftime Report. Let's get started. We have a lot of ground to cover, starting off with the headlines. So it's green on the screen for now. Let's straight away get started with the movers and shakers on the street. Joining in first is Ekta. She's got her eye on a couple of pharma stocks. Ekta?
Well, I'll start with Glenmark. That stock is in focus on account of the 5 observations which were issued to the Pithampur unit getting public. So most of the analysts are quite sanguine about it. They believe that maybe there could be some amount of time that remediation could take for these 5 observations, but eventually there should probably be approvals which should come through. The company also received an approval for an oral contraceptive some time ago, and hence that probably aided in terms of sentiment. Separately, Aurobindo Pharmaceuticals is in focus on account of the 3 observations being issued to the company's Unit 16. It's a new facility, and hence the street is quite positive on the company solving those observations as well. So there's no sort of material impact in terms of fundamentals as yet. And separately, there is positive news coming in for Cadila, where their Ahmedabad SEZ unit, in fact, was cleared by the USFDA with 0 observations.
Okay, all right, Ekta, thanks so much for that. Well, hopping across to Abhishek. Abhishek, tell us about Capital First as well as IDFC Bank.
Well, Nigel, let's look at the contours of the deal. One share of Capital First will get about 13.9 shares of IDFC Bank. So the deal values Capital First at close to 5,454 crores. Current market cap of Capital First is at 5,400 crores. So there's limited upside in Capital First over there. What this means on the equity of IDFC Bank is that IDFC Bank will have to dilute close to 29% in its equity base, while the book value of IDFC Bank in the combined entity can decline by 10.2%. As per my calculation, the consolidated book value comes to around 40 rupees versus 45 rupees of book value that IDFC Bank has currently. It's a win-win situation for both the companies. IDFC Bank gets an access to the retail franchisee of Capital First, wherein the customer acquisition will be really strong, while Capital First will get access to corporate portfolio, and most importantly, they'll get converted into a bank. Both the stocks were at 52-week low yesterday, and that is why we are seeing a gain in both these stocks. Let's listen into the management of both the companies to understand the deal much better.
I'll be the non-executive chair, and Vedya will be the CEO. Okay. That's nothing has changed on that front. IDFC Bank's retail book is now over 8,000 crores, going to 15,000 crores by March 31st. And CFL standalone book is, well over 26,000 crores, and that's growing at 35%. So the combined book you can comfortably say the retail book will grow at least by 25%.
Both institutions that the RBI has provided an NOC for the merger of the two institutions. They have asked us to take approvals from NCLT, and NCLT process will involve taking approvals from both shareholders and creditors.
All right. So what is the timeline that we are looking at for the entire merger to get completed? Because RBI's approval was one of the very important hurdles that you have crossed.
About 4 to 5 months we expect.
All right. So next, you have to go to the shareholders. When is the voting expected, Mr. Vaidyanathan, and how confident are you that the voters will really give their nod for the merger?
The answer to when is that when we apply to the NCLT, at that time as part of the process, we need to go to the shareholders. And as far as our confidence of getting the approvals, we believe that this can set the stage for a really excellent bank in the making in the future. And we believe shareholders will see the long-term impact and long-term value of creating a bank of this nature.
All right. When it comes to the RBI's approval, now there are two important things. You have a shareholder, which is the parent company of IDFC Bank, IDFC Limited, which by way of the merger process comes down to about 38% by way of the merger ratio. Now, has the RBI asked them to go back to 40%? What is the technicality there?
As one of the conditions of the approval, RBI has insisted or asked that IDFC Limited should continue to hold 40% of the merged entity. As of now, if the merger happened, it would probably be 38%, which means they have to acquire probably 2% of the market.
Okay, so that's Capital First, all set to go forward with that merger with IDFC Bank. Some more stocks that we have our eye on, HEG and Graphite. There's finally some green on the screen after several down circuit days. These stocks also became a part of this additional surveillance mechanism list that's been put out by the exchanges. Nigel has his eye on those moves. Nigel?
That's right. You know, both those two stocks, they did correct more than 15% after they came into that surveillance measure. That's ASM. Now, Jefferies came out with the note. They said that this dip is a good buying opportunity. They say that, in fact, in terms of graphite electrodes, nothing has changed. Fundamentally, everything is strong. The demand supply continues and the situation is strong out there. More number of steel companies will start producing steel via the the electric arc furnace route. So that will be good for graphite electrode demand. They're saying that, in fact, the contracts for the next couple of quarters is much higher than the the prices or the realizations we saw in Q4. So that bodes well for these stocks. And in fact, they're saying if Chinese graphite electrode is something that's worrying the market, then they should not be worried, because the grade of graphite electrode is totally different. That's much more inferior in comparison to what Graphite India as well as HEG they are producing. They're saying that, in fact, even global producers like internationally, they have fixed prices between around $17,000 to around $20,000 on a per ton basis, and valuations are cheap at around 2.5 to around 3.5 times odd. That's why they're reiterating their buy rating on on HEG as well as Graphite. Both the two target prices should come up for you on the screen. HEG 4,400. I think on Graphite India it's at around 1,275 after a while. Green on the screen on both these two stocks.
Oh, yeah, absolutely. So let's see if they are going to get back to their winning ways. A lot of momentum surrounding these stocks. Let's now move on to a couple of infrastructure companies that Anisha is watching out for. Anisha, there was a cancellation of a particular contract. Tell us more.
Well, yes, Surbhi, a lot of mid-caps are seeing recovery, but the likes of NCC, Gayatri Projects, as well as PNC Infratech are trading off these highs pretty much in the red. And the reason is the Purvanchal Expressway order that the UP cabinet had earlier passed has been taken back and cancelled. Now, the companies had not got the official letter of award, so it doesn't mean that they'll have to write down their order book. But nonetheless, the street had already priced in these orders coming to the likes of NCC, L&T, PNC, Gayatri Projects, etc. And that's why seeing a bit of negative sentiment as far as those stocks is concerned. Remember, this is a large project, 340 kilometer and an 8-lane project, and the total project cost was around 13,000 odd crores. Now the expectation is that the project will be re-tendered and the prices will be a lot lower. So let's see whether it impacts the margin of these companies as well as the order wins. Back to you.
Okay, all right. We're tracking a couple of more companies. One is Indiabulls Real Estate. Remember, the buyback commenced yesterday. And yesterday itself, the stock had moved to around 160, 170 rupees odd. We saw the promoter, the company, in fact, coming in and buying back right away at around 175 rupees on a per share basis. They picked up around 27 lakh shares. Remember, the total quantity that they could possibly pick up is around 2.6 crore. So in that context, in fact, it's around 11-12% of what they're looking to pick up. So they still have good headroom. Remember, we already have the details with us. They're looking at buying back at a maximum price of around 240 rupees on a per share basis. They want to spend maximum up to around 624 crores. And in fact, that explains why the stock is seeing a bit of a relief rally. Yesterday, intraday, it went even towards that 160 odd mark. The other stock we're looking at is Thirumalai Chemicals. Remember, the stock had corrected more than 40% from the highs that we saw in January. The stock trades at less than 10 times, around 8.5 times its trailing earnings. And yesterday, the promoter, they decided to come in there and give some support. So they bought only 80 lakh worth of shares. But the street seems to be excited. Today is that sort of a day when you see mid-caps bounce up. And this one as well is participating. But those are all the stocks that we covered in this Movers and Shakers segment. So let's do a quick recap of all the stocks we just covered. We have Capital First, IDFC Bank, pharma stocks like Glenmark, Cadila. You have HEG, Graphite Electrodes, green on screen after a while, and infra companies like NCC, Rel Infra. You have Gayatri Projects, L&T, PNC. And finally, Indiabulls Real Estate, as well as Thirumalai Chemicals, promoter buying and the buyback option supporting both those two stocks.
Let's get you that promised exclusive. Lata caught up with Chetan Iyer, who, of course, tracks global economies at Morgan Stanley. And this was on the sidelines of the Morgan Stanley Investor Summit. She asked him about what he thinks of global growth at the moment and whether he is expecting a rate hike from the RBI today.
There are challenges. You are seeing problems in terms of central banks tightening in DM. And so that's going to be definitely some kind of a challenge for growth to continue. But to the extent to which this cycle has been driven by capex and productivity, which has really happened for the first time after the deceleration in capex that we saw since 2012. And so to that extent, it is on a much stronger footing. It takes a lot for a capex-driven cycle to be turned down by the challenges that we are seeing right now.
You know, some of the things that keep that are brought to us as red flags. One is that even in the U.S., the difference between the 10-year yield and the 2-year yield is now, it's almost leading to a flattening curve. And so, is there a recession? Fears like these are unfounded, you think?
So actually, I think the comparison on that front would be 90s, when yield curve was flattening, and it was relatively around 50 to 75 basis for a long period of time. And guess what was similar to this cycle? Capex was strong. So if you have productivity-driven, capex-driven growth, then the economy can withstand higher interest rates and does not have a problem then.
Okay. So what about EMs then? Do you think they benefit from this? Or, lately, look at the outlier. Maybe these are only outliers, Turkey, Argentina, but even Indonesia had to raise interest rates. So is there a fear of, dollars moving away from emerging markets?
So look, Lata, the way we approach EM's outlook is that we need to first see how their own policy mixes and macro stability indicators are, and then you evaluate that in the context of rise in interest rates in the US. Now, and in that context, taper tantrum and commodity price fall in 2014-15, we think were the triggers. The reality was that these guys were misallocating. So now when we take all the large EMs, bulk of them are doing fine on policy mix and therefore on macro stability indicators.
What's your sense about the Indian financial conditions? Do you think that, are you expecting 1, 2 rate hikes and one today itself?
No, we don't expect the central bank to hike today. Of course, there's always a possibility. But I think looking at the fact that the underlying inflation trend in India is fine, and ultimately that has been the framework that the central bank has provided us. So looking at the trend in inflation, particularly food inflation, which is a big component, it doesn't worry us that the underlying inflation trend is quite okay. On our forecast, we expect the core inflation in India to be going to around 4.3% by March 19. So we think that the trajectory is looking comfortable with the facts that we have. But if you do see a big problem on oil and oil shoots up in a short span of time, then there will be that inflation pressure which the central bank will have to consider. Okay. But I think with the facts that we have, we think they should probably hold today, sound a bit more hawkish and say that, look, that easy monetary policy condition that we had so far is done, and one should be prepared for interest rate hikes in future.
Okay, so a hawkish pause would be more like it today.
Correct.
But for 2018, what are you expecting in terms of rate increases from the Reserve Bank? Will it come in August? Will there be more?
So we see one base case rate hike in last quarter, but we do appreciate the fact that oil prices have moved a bit higher than what we were building in our forecast. And so there is a risk that they could do a rate hike in August.
Okay. Oh, in August. But you only expect one and done?
No, we're expecting 2 more. So in all 3 hikes in our forecast horizon. So it will be a shallow rate hike cycle. Unless you see a big misallocation or redistribution by the government before election, which then brews up inflation in 2009.
What's your sense? Is the rupee appreciating too much and therefore rate hike can actually hurt? You know, in real effective exchange rate terms, just about before this current bout of depreciation, we were overvalued by 21% at the end of last year. Now I think it's come down to whatever, 15% or 16% overvaluation. So, what's the sense you're getting in the rupee itself?
So look, I think the fundamental valuation of the currency that we look at would be in conjunction with terms of trade. You can't just look at real effective exchange rate and versus trend and say it's overvalued. So we think currency is relatively fairly valued on that metric if you consider terms of trade in the background. And the other evidence is that the trailing current account balances have been fine. So that's also telling you that the underlying valuation of the rupee is fine. And so I think the 2 variables which we need to consider. First is what happens to the dollar. We always look at rupee in isolation. Everybody asks me, what do you think about the rupee versus the dollar? My counter question is, what do you think is going to happen to euro versus dollar? And so if you see even the recent bout of depreciation, the rupee is actually moved in line with euro, in fact done better than euro.
Yeah,
so,
it's much more stable.
It's a function of what happens to the dollar. And as I mentioned earlier, our FX strategy team is forecasting that the dollar will decline. Okay. So I think from that perspective, you should have reduced pressures. And then the other thing is what is going to happen to commodity prices, because terms of trade is also another variable. So if commodity prices rise, then it makes sense for the rupee to depreciate and adjust in line with the terms of trade deterioration.